yours is the kind of voice that I guess all investors in the street really want to hear. What is your assessment of this ongoing correction right now in the market, Nilesh?
So essentially what we are seeing in equity market today is function of volatility and events in debt market, credit market, currency market, oil market and liquidity. One, oil went up from about $55 last year to $85 now. That's a jump of almost 50%. India's current account deficit expanded by more than $20 billion because of oil price movement. Second, interest rate moved from 7.23% in April 2018 to 8.15%. That's almost a jump of 100 basis points despite inflation coming down. The increase in interest rate is function of hike in US interest rates, also concerns about fiscal slippage courtesy higher oil prices. The third thing was related to currency, where rupee moved from 63 to 73.5, and that is also a function of higher oil prices and widening current account deficit. And the liquidity was running very tight from 15 September to end of the month, and many NBFCs were finding it difficult to roll over their paper, refinance their paper. And on top of it, there was a credit market event where ILFS went from being AAA to D in a very short period of time. Combination of rising oil prices, rising interest rates, weakening currency, expected rise in fiscal deficit, tightening liquidity, and credit event created its own shadow on the equity market, and the downfall or correction or a crash in equity market is function of combination of all these markets.
Right, Nilesh, this scheme to boost retail FPI debt investments, what's the relevance of this move in the RBI's policy?
Yes, I think it's a very good step taken by RBI. So essentially it says that if you are an FII and you commit to keep your money for 3 years or such a period, then you have the choice of taking maturity of one-day T-bill also and 10-year government security also. So effectively that restriction which was imposed on FIIs, that you have to buy minimum certain level of maturity, as long as you are committed to keeping your money in India and not taking it out, you can buy any maturity of paper. So by declaring that I'm voluntarily going to retain my money in India, you are allowed to take entire maturity curve from 1 day to probably 30-40 years. And that's a very good step in the right direction. It shows a very matured response from RBI, and debt FIIs will definitely appreciate step taken by RBI on this voluntary retention scheme.
Right. Is the good news of earnings recovery in the price, Nilesh, and is it no longer the tailwind that can support the markets at a time when we are faced with a lot of macro headwinds?
At this level of prices, earning recovery story is very much into most of the stocks. Clearly, Indian markets were trading at higher valuation in anticipation of earnings recovery. On 16 Jan 98, small caps were trading at 33% premium to its 10-year historical price to book. Mid caps were trading at 25% premium and large caps were trading at 10% premium. On the Friday closing, mid caps are now at about 12% premium, but small caps are at 5% discount and large caps are at just about 3% premium. So that premium valuation in Jan 18 was in anticipation of lower oil price, lower interest rates and earnings recovery. The current valuation has discounted to a great extent movement in interest rates by 100 basis point, more than 50% movement in oil prices over last 1 year, potential slippage in fiscal deficit, but it is also at the same time discounting potential earnings recovery whose trend was visible in December 17 quarterly results, got reaffirmed in March 18 quarterly results, got reconfirmed in June 18 quarterly results.
Nilesh, one wonders what happens next. How prolonged can this corrective phase be in your view? And the bigger fear in the markets, as any of us, is whether or not it can stretch to as long as 1 to 2 years after this corrective bout, which is playing out.
So the worry on the equity market, if we see, on the interest rate side, a majority of that is factored into the equities. Yields have moved up by more than 100 basis points. The real interest rate is now almost 4% plus. Inflation has been reasonably under control despite higher oil prices. And that real interest rate of 4% plus hopefully will start stabilizing yields around current level, give and take little bit upward movement based on what happens in policy. On the liquidity side, liquidity has become neutral with RBI's OMOs and government spending. And more importantly, RBI has also announced OMOs of 36,000 crore for the month of October, comforting market that they will maintain positive liquidity. On the currency side, 63 to 733.5, a major move has happened. Rupee will fluctuate, but hopefully it will start stabilizing around current levels in some time. On the credit side, government has superseded board of ILFS and appointed new empowered group of people. Hopefully they will resolve the issue because ILFS is a liquidity issue, not a credit issue. So many of the events and volatility of debt market, credit market, currency market and liquidity is broadly discounted into equity prices. There could be 10-15% more bad news, but majority is already discounted. Now the real issue for us remains oil. If oil is going to go to $100 and stay there, there is more downside to the market. But if with our luck, if oil starts flowing back to $70 a barrel, there will be upside in the market. So from here onwards, we think markets will be impacted by oil and election.
Right, Nilesh, give us your view on the oil